Welcome to the Startup Grind.
Now it's time to get down to business. Our featured speaker tonight is Brian Smith, managing partner of Grayhawk Capital, which is a venture capital firm located here in the Phoenix Valley. Brian has nearly 25 years of experience in venture capital. He has seen many types of companies and managed investments through many types of economic situations. We are actually really fortunate to have such a seasoned VC here today to help us better understand the landscape of different ways to fund and grow your business. So get up on your feet and join me in welcoming to the stage Brian Smith. Come on up, sir. Hey. Thank you. So, I am really excited about this interview, you guys. Some of my very favorite interviews, if you have watched any of them on our website, are with some of these people that are kind of behind the scenes making a whole lot of shit happen when it comes to the entrepreneur world. So we're going to get to know Brian on both a personal level a little bit as well as tap into his experience. Starting with, tell us about your early life. Where are you from? What sort of culture and family did you grow up in?
First off, thank you for having me on Startup Grind. I was noticing the last two speakers, Doug Ducey and Pat Sullivan, and they're very public figures, and I put my name there, and I thought, one of these names isn't like the other two here. But anyway, really appreciate you having me. I actually was born in Phoenix, and I'm a third-generation Arizonan, which is quite rare. Most people who are here have moved here from someplace else, and so kind of family goes back to northern Arizona, 1800s, a lot of farming and ranching, and both my parents grew up northern Arizona on little farms and ranches, and so I was the youngest of 7 kids, born here in Phoenix, big extended family, and family's always been important, and it's been great to have family around, an extended family, and so anyway, that's a little bit of my background.
Very cool. So what did your parents do?
So my dad, my mom had a lot of kids.
Yeah,
so
okay, I'll give you that.
That was a given.
She had her hands full.
So she took care of a lot of kids, and my dad was a veterinarian.
Oh.
And he was, early on, helped get the Phoenix Zoo started. It was Robert Maytag. Had this collection of exotic animals and was getting older and didn't know what to do with them, and they decided to make a Phoenix Zoo. So because he helped start it, he actually was the first zoo veterinarian. And so my brother and I spent a lot of time at the zoo. I had a brother just older than me, and our house was kind of a mini zoo. We had baby bobcats and a fox and tons of snakes and baby alligator, and so we had all these things growing up. And so I wanted to be, this will date me, I'm getting a little bit older. You remember Mutual of Omaha's Wild Kingdom? Marlin Perkins. I didn't want to be Marlin. I wanted to be Jim, right? Jim was the guy who jumped in and grabbed the anaconda and rappelled down and grabbed. So that's what I wanted to be. And until one day my dad, he did surgeries on the lion and the gorillas. It's really a charmed kind of upbringing. And so one day they had to move the orangutans. They thought they had tuberculosis, and they had to move them across town to get x-rayed, and they had to keep them conscious. And so my dad's like, do you want to get out of school? Well, sure. So I go down, and we grab some of the orangutans and tranquilize them and throw them in the back of this van, and we're driving for 45 minutes, and we each have kind of an arm and a leg, and this orangutan's looking at us.
What?
And all of a sudden, the orangutan just lets out this shriek and lifts us all in the air.
What?
And we're all scrambling. And anyway, I looked at one of the zookeepers there and says, whatever you do, don't get your hand by their mouth. And I said, well, why? And he goes, because of this. And anyway, this orangutan had bit off one of his fingers about 3 years ago. So that was the end of my aspirations about wanting to be Jim on Mutual of Omaha. I didn't want to do that anymore. But anyway.
I believe it. So then what did your first few jobs end up being?
So they were, growing up here in Phoenix, there were a lot just on Camelback, mowing lawns and Baskin Robbins and bagging groceries and being the busboy at Pizza Faro's and digging a lot of ditches and landscaping, a lot of that. My dad, being a Depression era guy, he was a proponent of hard work.
I believe it.
So it was, and frugality, which meant if I wanted money, I had to go get a job. But it was great because I was always looking to make some money.
Yeah, it motivates you.
Have in my pocket.
Oh, very cool. And then when you, so you ended up getting degrees in accounting and finance and economics. So which study was most interesting to you in college, or what kind of?
Accounting was probably the most boring, and I did that undergrad, and most of my family was in medicine in some way, shape, or form. And but my friends whose fathers were in business, I can ask them, what should I do? And they said, well, get an accounting degree. I always wanted to start my own business, and they said, go get an accounting degree. It teaches you the language of business. And I realized really quickly that I didn't want to be an accountant for very long.
You love numbers, but not that
exactly.
much.
So when I went back to grad school and did finance and econ, and I just loved that. I really loved economics, and finance came pretty easy after accounting.
What makes a person really love economics? I mean, what draws you?
I know. I guess I should be careful in saying I like the macroeconomics, trying to figure out how everything interrelates and what's going to happen with economies and things like that.
Very cool. So part problem solving, part projections. Yep. Cool. All right. So when you did get out of college, you took a role in emerging business services. What is that?
So I was with Deloitte Haskins Sales had their practice, and they had the auditors and the tax guys and the emerging business services, and that sounded a lot better than audit and tax. So that was
by default?
A little bit by default. But while I was doing that, and I knew I wanted to go back and get a graduate degree, but while I was doing that, I was fortunate in that there was a couple clients that we had. So we had the small businesses and the entrepreneurs.
And what kind of services did you provide?
So we would go in and we would do reviews and would compilations of the numbers, and would still do the audit and tax and some of those things. Would just work with the smaller companies. And there were two of them that were venture-backed in Phoenix. And this is in the mid-'80s, which is pretty rare for there really to be that much venture capital here. And there wasn't that much. And I thought, well, this is pretty cool. These guys, this was my perception. They fly into town, tell management team what to do, and then they leave for a month. And then they come back, and that's not how it works. But that was the perception. It looked a lot better than just doing numbers. So I became intrigued with private equity through that.
Oh, interesting. Okay. And then after you finished your master's, you did an entrepreneur fellowship?
Yeah.
That sounds cool.
So while I was in grad school, there was a venture firm in Indianapolis, and I went to Indiana University for my MBA degree, and they had a kind of an entrepreneur fellowship. You could spend the summer working there, and it was a fantastic experience. And it really solidified that I wanted to be in private equity and venture capital. They had, there were two of us, and they had two companies, and they had this little software company that was just taking off. And the other individual, he had a sales background. So they said, Tyler, you go with the hot company that's taking off because they need sales help. And then they had another company that was just burning cash like crazy, and they fired the CEO. And they're like, Brian, you're the accountant numbers guy. You go fix this. And so I ended up spending most of the summer in Columbus, Ohio, and it's just kind of a 24/7 working, but I loved it. You know, when you find something you're real passionate about, it becomes fun. And so anyway, Tyler ends up dropping out of MBA school. His company goes public, and he made several $1 million before he turned, I think, 32. And my company didn't do so well. I went back to school and then left from there. But it was very interesting. The firm was small, and most of the partners there really didn't come out of a venture background. They came out of some really great industry experience. And so I remember sitting down talking with one of the older partners, brilliant guy. He really had a manufacturing background. I said, I really want to make a career in venture capital. And this was 1990. So before, you think of all the great technology markets, really before a lot of those emerged. And he said, Brian, I think you're making a huge mistake. He said, the personal computer was a once-in-a-lifetime fluke. And we're never going to see this again in our lifetime. And I'm afraid you're going to spend all this time trying to back these companies and not be successful. And fortunately, I didn't take his advice. And he really is a bright guy. He's just more of a manufacturing background. But I've often thought about that. I think he missed networking and then the internet, mobility, and some biotech and clean energy. And I think fundamentally you either believe in the ability of humans to make the world better and create technology and advance, or you don't. And I think for all you entrepreneurs and people involved in technology, you're really the believers that you can make the world better and make the world more efficient and everything else.
Very cool. So then from there, you actually went straight into a VC role.
I did. I packed my bags, and I knew one person in Silicon Valley, and they let me sleep on their couch for a month, and I started knocking doors. I had a couple offers getting out of school, non-venture capital related, and because venture industry, it's a small cottage industry. I was very naive on the odds of being able to get into the venture capital industry.
Naivety gets a lot of things done.
Naivety's good
to
a point.
Right?
But naivety early on is good. Otherwise it would kill all the passion that people have about things. And I went and really just started knocking doors in Silicon Valley and took a couple part-time jobs and was out of money. My parents gave me a little bit more money, which was good. And then finally, Dominion Ventures offered me a job. But I was disappointed. They offered me a job as an analyst as opposed to an associate. They were in between funds, and I really learned a great lesson there. And so they offered to pay me less than I made before I went to MBA school. And that was, when you're young and you think you're getting some experience, and I think that was a little slap to my ego. But then I started thinking about that. I thought, well, one of three things can happen. The first is, if I go there and they don't like me and I leave, I'm working with all the best startup companies in the world. And there's a chance I'm getting a job with one of them. Or I'll meet all these other venture capitalists, and there's a chance of jumping over and working with one of the other venture capitalists. Or if things work out, I can become a partner here and have a career in it. And so it really taught me that early on in your career, I really think the first 10, 15 years, you should always go to the place where you get the best experience. And I think, you'll be happier and you'll have more financial rewards down the road if you do that. And I was fortunate. I became a partner there, and we ended up running a few funds and had some good success there.
So what were kind of your first experiences like?
Right when I got there, I went to this conference down in Monterey. There was this annual conference, and so I went there, and I was a little bit shell-shocked by, you've got Bill Draper and Don Valentine, and you have all the kind of the icons of venture capital, and they're all there because it's a small industry. And I saw Don Valentine at Sequoia Capital, and who had backed Apple and Cisco. I remember kind of, going up to him. Hi, Don. I'm Brian. And I remember he just kind of looked at me, kind of like, who are you? And I think I learned real quick. Okay, Don's probably not going to give me a deal. I better get my own network going with my peers. And so that was one of my first experiences. The other thing was, it was in the 1990s. The technology was taking off. The public markets were taking public pretty much any software company or information technology company. And so we had a number of companies that went public, which was a lot of fun. After the tech bubble burst, or the dot-com bubble burst, then you pretty much had to find companies to buy your company by good strategic partners. But it was a lot of fun, and about half of the venture capital that was available in the 1990s was just right there on Sand Hill Road, and we had an office there. And so it was fun to rub shoulders with all the people who were financing, all the great businesses that got financed.
So before we dive into the rest of your experience, let's take a moment to kind of just do some education on the landscape of opportunities available to grow a business. I mean, people can bootstrap it. They can start with some friends and family investors. They can go to an incubator or an accelerator that might have a leg that does some investing. They can approach angel investors. They can try and work with a venture capital firm. Even now there's the new crowdfunding investment opportunities. And so let's talk a little bit about kind of your perspective on the pros and cons of each one and what's a good fit for different things at different stages.
Yep. And I think really the first three of those, most companies that get started use all three, right? I mean, you have to bootstrap and max out the credit cards and some of those things to get a business going. And then family, you turn to family till you run out of family members who will talk to you, and then you go to friends till you don't have any more friends. And then we jokingly call it given that the success rate of startups is so low, the 3 F's: friends, family, and fools.
Oh, no.
And so, we say that jokingly.
Yeah, sure.
But then angels, and I think it's really important early on to, if you're starting a company, go out and find a great angel. Find an angel who knows your market, knows your business, can open some doors for you. Most of those angels have been CEOs. They've been successful before, and they're invaluable. And even when we put in money on the venture side, we're always looking for at least 2 great independent board members who can come in and just add a tremendous amount of value at the board. And so I think early on, really try to find a great angel.
And the angel is often going to do some equity exchange, but they also are going to be more of an involved party and a patient mentor.
That's right. Friends and family will be more money, but the angel is going to be the kind of expertise, someone who knows that business well, and someone who will also be equally passionate with you about it, which is important. And then on the venture capital side, most opportunities are really not great venture capital opportunities. A venture capital opportunity is one where, and if I were a CEO, this is the advice that I always give, you really want to go get venture capital if you have a big market and the window of opportunity is going to close rather quickly, and you need to get through that window and create some market share, grab some market share before that happens. And when that's the case, then venture capital makes a ton of sense. And that's when I recommend to entrepreneurs to get venture capital. Most entrepreneurs who come in, I usually tell them, you're not going to be a fit for venture capital. And when you're not a fit for venture capital, you don't want venture capital because there's more rules, and once you take venture capital, you've agreed you're going to sell your company, right? Because we have a 10-year fund and we have to have an exit for our investors. And so it's a bit of a different ballgame. But if the market's big and it's moving fast and the opportunity's huge, then you definitely want to take venture capital.
So let's go into that a little bit. Help people understand how a fund is established, and then what happens when you do work with a firm, how that process works. I mean, even people probably don't realize sometimes that you are moving towards an exit when you go to that level of things.
That's right. And so and I think sometimes people, when they come in, they don't realize we have to go raise money as well. Just as the entrepreneur raises money, we raise money. We don't have the ATM machine, back in the copy room or the money tree in the back. And I remember I had a young entrepreneur, real bright guy, came in, and he had been out and he had talked with about 12 different venture firms. And And he wasn't at the right stage for the investment. And so we were trying to give some advice on finding some good angels and things like that. And I remember he was a little, in his frustration, he said, "You don't know how hard it is to raise money. I've talked to 12 different groups, and I've been at this for a month and a half, and it's really frustrating." And he caught us at the wrong time. We had just spent 2 years raising a $70 million fund, and I sat down, I said, "Well," I tried to be polite, and I said, "We just spent 2 years meeting with 170 different groups in 25 states, out of our own pocket, raising this fund." And that just included first meetings. And then, his jaw hit the ground. I don't think he fully realized. But when we get involved, venture capitalists, I think if groups have worked with a venture capital group before, it's very clear on what they're going to do and the value they're going to add and what they'll bring to the table and how they're going to act. And venture capital groups aren't looking for control. In fact, we don't really want the entrepreneur to have control. We want it to be spread out. We want decisions to be collectively made. The management team has to run the company. If the company's getting turned over to the venture group to run, you're in big trouble, because we're working with 10, 15 companies simultaneously. And our job is to find people who are smarter than us in that space. And but more than anything else, we want to come in and just make sure there's good governance, talk about the strategic issues, positioning of the firm for when the company ultimately gets sold to create the most value. Those are the things that are most important to us.
And oftentimes the way that logistically happens is through a seat on the board of directors.
That's right. And so typically you'll have 5 or 7 board members. Usually there's the CEO, maybe another common director, an independent outside director, and a couple venture capitalists. Or if it's a 7-member board, then you can get 3 independent board members, which is usually what we like. Those independent board members, and for anyone starting a firm, they add so much value because they've been in your shoes before. They know what you're thinking. They know the challenges you're going through, and you really feel like you have someone you can confide in and work closely with. And you feel like you have an advocate there instead of someone who's just trying to push to get the business grown.
Very good. So in addition, I think another possible misconception is the fact that a VC firm isn't just a generic place to go. There are different firms that specialize in different verticals.
That's right.
So, as an entrepreneur moving in that direction, if a VC firm is a good way to pursue things, then you have to get a little more custom than that.
Right. So you will want to target a firm who's at your stage, whether you're seed or early or kind of growth or later stage. You'll want to target a firm that's specializing in what you're doing. Most venture groups are really focused on information technology right now more than anything else. But there are some biotech groups. There's still a handful of clean tech companies. You just want to know what firm you're getting involved with. And then it's real important that you feel like you have a good working relationship with that partner. Every partner, partners have different personalities, and it's, I used to joke, it's when you go raise money, it's tougher to get out of a relationship with your investors than it is a marriage. And so you need to make sure that you really work well together and you have the same goals and objectives.
Back to that whole thing that if you don't need one, you probably don't want to be in one.
Exactly.
Not the marriage,
yeah.
the investment. Yeah. So then, touching on what you kind of mentioned there, explain the landscape of how it works with seed funding and then different rounds and bridge and stuff like that, because again, that's an area that different firms are going to specialize in different stages as well.
So seed funding is when it's pre-revenue. When you have a good idea, you're starting to put together the team, you're trying to, you know what type of product you want to create, but you need money to go out and create the product and start executing. And angel funding goes in with that. Most venture capital and venture capitalists used to do a ton of seed financing. It's probably less now than they used to do. And I think part of that is when the dot-com bubble happened, there's a lot of money that got lost and people got burned, and ideas are kind of a dime a dozen. You want to see a team start to execute. The first round, kind of the startup stage, is usually when you're out there and maybe you're getting some initial customers. You have a product and you're selling the product, or you're just starting to sell the product, or maybe it's in beta, but you have some customers who are using it. And that's kind of your startup round or your Series A round. Your B rounds or your growth stage where people are buying the product. The dogs are eating the dog food. They want more. And you need the money you're always going to be doing ongoing development and then sales and marketing with it. And then late stage, growth stage is really when you're getting close to financial break even, or you could be financial break even, and you want to step on the gas and really try to grow, not be too constrained on profits because you're trying to grab market share.
Very good, thank you. And so when it comes to what would you say is typical? I mean, when it comes to companies that, if it is a good fit for them to do that, do you sometimes see them coming out of accelerators or from angels or a combination of all the above? Like what's preferred or what's helpful?
There really isn't a preferred. They come from everywhere. Sometimes it's from accelerators or incubators. Usually it's not. We don't have a bias one way or the other. Usually it is. We just want to see how good the management team is. Do they know this space? Can they execute in this space? How good the technology is, and then how big the market is. But it comes really from all over the place. It really does help if you have experience in the space that you're trying to raise money for. It's not as important that you've necessarily done it before or been wildly successful, but if you know the space, if you have telecom software, you should know the telecommunication space, right?
Sure. Yeah, absolutely. And I think it's interesting. I feel like sometimes people, as they're coming into these things, they like to pretend that they've always done everything perfectly leading up to now. But isn't previous failure kind of a good thing in some ways because they've learned?
I think you learn more from your failures than your successes, and I like a combination of if someone's had a success, so you know how to be successful, but you have had a failure as well.
Yeah,
I think that's a great thing. We get nervous if someone's coming in and they're 30 and and they've only done one company. It was a huge hit. You know it's going to be a disaster because the thought process is, well, everything I touch is going to turn to gold, and this is going to be great. And so having that mix is really important.
So all that being said about the landscape of how everything works, you guys are really, I think right now, the only VC firm in Phoenix. And how do you guys fit into things? What's your niche on how you approach things?
So we just raised a $70 million fund. We'll be focused here in the Southwest. We've made 5 investments in the fund. We'll make a total probably about 14 investments, range from about $3 million to $6 million. We're focused almost exclusively on software and IT infrastructure. We found my other 2 partners, Sherman Shue and Brian Burns, have both been doing venture capital for about 25 years as well. And we put all of our companies together and all the companies from our funds, and consistently software has done better. It's easier and quicker to start. The markets are big. You don't have a lot of inventory. The delivery mechanism is wonderful. You just go on the website. You can access it from anywhere in the world and download it. And then when you sell the companies, you tend to get pretty good multiples. So We like software. Tends to be a little more capital efficient than most businesses. A good software company can get to profitability with anywhere between about 6 million, maybe up to 15 million total invested, and usually that a couple of good venture groups can provide that. So that's what we've liked. We cover Arizona, Utah, Colorado, Southern Cal, and really into Texas, kind of our focus. We do see a lot up in Silicon Valley, but there's 100 plus groups up there, and I figure anything we're seeing, unless it's proprietary from someone we know real well, it's probably been picked over by 20 different venture groups.
Right, that makes sense. Very cool. All right. So what do you think is the greatest misconception about venture capital firms?
I think sometimes there's a misperception that they want to come in and control everything or run everything. Our whole goal is really just to find the best opportunities, help them grow. They can only grow if the management team we're working well with the management team, and then try to get the best exits that we can. And so I think sometimes if people have not raised venture capital before, that can be a misperception. But I think people who have gone out and raised venture capital a couple times understand it pretty well. I was on a business trip in Austin, and we were working with the CEO, and he's been through venture capital with 4 different companies. And he was introducing us to another company, and they were asking questions like, okay, well, how much ownership do you want and control and this and that? And he said, time out. Let me tell you, these guys just want to create great businesses. And, they're interested in probably having 10 to about 20% ownership. They want to work closely with the management team. They just want real good information out on a regular basis. And that's really what they want. And it was great. We didn't have to say anything. We didn't have to sell ourselves at all.
Awesome. That's good. And I would imagine that it varies a little bit firm to firm. So I would imagine that some firms are more focused on, empowering the entrepreneur, and some are more focused on taking.
I think that's accurate.
Good. So, what are some of the qualities in your experience that you have come to look for in entrepreneurs themselves? I mean, separate from the business, just in the entrepreneur.
Perseverance is number one.
That's definitely required.
Passion is probably number 2. And I think everything else falls way below that. There's been some books out, you probably read them, Talent is Overrated and Outliers and some of these things. And I think sometimes the perception is, well, the entrepreneur has to be brilliant or incredibly talented. And I think more than anything else, it's perseverance. It's not being afraid to fail. If you're afraid to fail, being an entrepreneur is not the right place. Because you do learn more from your failures than anything else. And earlier in the year, there was a guy named tennis, and I don't know if many of you follow professional tennis. Is it Stanislaus Wawrinski, I think is his name. And no one's probably heard of him. Maybe a handful of you have. I had never heard of him before. So he had played in 48 Grand Slams and never made it to the finals. He had played Nadal and Djokovic, and he was 0-27 against them. In fact, he had never won a set against Nadal. And he ended up winning the Australian Open, and he beat both of them in the process. And so that's a pretty phenomenal thing, right? But what caught my attention is on his arm he has tattooed, ever tried, ever failed. Repeat. Tried again, failed again. And then at the end he has written, failed better. And that's an entrepreneur. That's an entrepreneur. And I was just very inspired by that this guy would stick around long enough to finally win. But that's really the type of spirit that you need with an entrepreneur. Is you're going to fail keep feeling better, right? And until you finally start having some success.
Good. So any memorable stories about entrepreneurs that you've worked with?
Yeah, a few, and most of them have been really positive, and I'll have to be careful on some of the things that I say. Maybe one. I remember getting a phone call in the office and picking up the phone, and this is so-and-so from a certain department with the U.S. government. And I thought, this is not good. And he says, do you know that your CEO is under criminal investigation? So he had my attention. At first I thought, this has got to be a joke. And I think I even probably made a stupid wisecrack. It was not a joke. Fortunately, it was for something previous to being the CEO of the firm.
Oh, good.
So anyway, it didn't. But his last comment was, "So will you cooperate?" I thought, yeah, well, we're definitely going to cooperate on this one.
That's a memorable day for sure. So what were some of your most successful investments? Any that surprised you in how well they did? Or
Yeah, in the 1990s, was fortunate to have some go public. Was involved in Coinstar. You probably see the little green boxes, and that was one where the founder actually he had an entrepreneur class when he was getting a Stanford MBA, and he came up with the idea. He found out that most people had, I don't know, $50, $60 of coins just laying around their house. And so one of the very first ones that he put in was buy our house. The Safeway buy our house, I think he only had 10 units in. And so anyway, when I came across it, I became kind of intrigued. And that was a kind of an easy one because you could literally just run the numbers on how much they're making and payback. And so was involved in that, which was a lot of fun. That was up in Seattle. Was involved in PCOM and Efficient Networks. They were tech deals. Efficient Networks was a DSL company. So when the internet started taking off, early days, it just took off. PCOM was a wireless radio deal, which was interesting. So in the 90s, those were fun because any company that would just start to move, the public markets would swoop in. You go public. You think you're brilliant because you're not even, the companies aren't profitable, and you just kind of hand it off and you get your stock and you move on. And then after the bubble burst, you realize this is a much harder business than I ever thought, and because you really had to create companies and get them all the way to profitability. You had to really go out and get some market share. And in the last 10 years, I'm fortunate to be involved with Quality Care Solutions, Inc., which is a Phoenix company, healthcare IT company. We grew to about $60 million and sold to TriZetto. And then PowerQuest, a Utah company. It's kind of hard drive management, sold to Symantec. But, instead of getting it to 10 or 15 million in revenue, you really had to get it up to kind of this 30 to 60 million in revenue before you could get a really great exit. Communispace was another good one.
Yeah, let's talk about that one for a second. I was, in looking at the different companies that you're on the board of directors for, that one kind of caught my eye. It's a company dedicated to improving businesses through consumer collaboration. So they really, really deep dive into the consumer experience of a brand to help that brand improve. And I mean, they've worked with some giant brands, McDonald's and Hallmark, I think you said. And so tell us a little bit about their journey.
It's an interesting story. Communispace originally went in and was trying to help big corporations have better internal communication and collaboration. And one of the very first customers they got was Hallmark. And we were an investor in the company. And Hallmark came to them and said, this is nice, but what would be really helpful is if we could set this up for all of our customers and consumers and find out what they like about us and what they don't like. And so the light bulb went on for the CEO and Diane Hessen, and she went out and started doing this. And we set up these online customer it's kind of chat, right? And so you online community, and you'd get about 200 to 300 customers out there, kind of the hardcore customers for the client. And so they've run communities. I mean, if you name a Fortune 500 company, they've done work for them. Walmart, Johnson & Johnson, Schwab, Kraft, Disney. Disney ran some real interesting communities. But one that was real interesting early on that they ran for Kraft is they had single working mothers who were concerned about their children and eating habits. They were concerned that, they'd say, well, and all this is online. You'd have someone work who would be kind of a collaborator and a facilitator, and then you'd get all these comments, and then they'd look for themes and trends. And one was, kids come home and they just kind of grab the entire bag, and the entire bag's gone when I come home. I wish I could give them 100 calories of chips or 150 calories. And the light bulb went on, and that's when you started getting these 150 calorie grab bags, and that came out of those communities. Yeah, it was kind of neat.
Yeah, that is interesting. And I thought it was interesting, too, just from a business model or a business process standpoint, that when you look at their website, it's not immediately apparent that it's a technology solution.
Right. That's right.
It looks like it's a strategy and a principle and a service solution, but it's really driven by technology. But you get so much more of an impression of value because it's more than just a technology, even though that's what's
really marries. You're using the internet, and if you've done any work with any market research, it's always surveys and focus groups, and it's very labor intensive. And then you're trying to get the feedback and collaborate all the feedback. But being able to do this online, where people can just comment online 24 hours a day, and having a facilitator occasionally put in a question or two, the feedback is so fast. And it's so much more relevant because everyone's feeding off each other. And being able to use technology to do that, to take really a traditional market research type firm and then marry it with technology, just added a tremendous amount of value. But I think one of the things that I liked about the story is, if you look at most great companies that were created building one thing, and then the market directed them to something else. Twitter is kind of a funny example. They were just using that internally, and then they realized, oh, maybe there's an application for this. If we like it internally, yeah, maybe. If we like it, then other people will probably like it. And so, but I think if you follow some of the histories of really the great tech companies and other companies that have been formed, they usually started doing one thing and then veered to a better spot in the market.
Very good. So, any you want to tell us about the lost money?
I haven't had any of those.
Wow, impressive. Wait a second, what happened to failures make you better?
I did hear a venture capitalist who had been in the business 25 years say that, and everyone went, no way. I remember the first time I lost money, and it was when the tech bubble burst, the dot-com bubble burst. Most companies were just spending money like crazy. It was all about grabbing eyeballs and market share and then going public. And we had this it's probably better if I don't name names, but we had this little company, and we had been in it 6 months, and someone wanted to buy us for 2.5 times what we put in. We're like, 2.5 times? We can take it public and make 10 times the money. Anyway, the world's changed dramatically for the better in some ways. It certainly makes you more humble, but anyway, so we worked this company. It was one of these companies where literally the more revenue we were getting in, the more money we were losing, and we could not get this thing fixed. And I was working with the other venture group, and the CEO and management team. It was a good team, and anyway, that was at least good relationships. But sometimes it's easier. It sounds counterintuitive to keep writing checks than to just say, we've tried everything. This isn't going to work, and we need to kind of pull the plug, get the employees paid, and then do a fire sale. But I remember it. Fortunately, it wasn't an in-person meeting, but when that moment came, I was on the phone and I started hyperventilating because I had almost $5 million in this. And I remember I hit the mute and I put my head down. And I was so glad, that nobody saw me, although this is getting videotaped. And I thought, I just lost $4.9 million, That's pretty sobering.
Yeah.
And so I anyway, I remember calling our managing partner and I told him and I remember his response. He started chuckling, which is not what I expected.
Oh no.
And he said, "I knew this was coming for the last 6 months. I just wanted to see how you're going to react. The writing was on the wall." And he goes, "This is the first of a number of losses." And I didn't really like hearing that, but you realize, in the venture world, about 1 out of 3 companies are not going to return capital. And that's just part of the nature of the beast. It's part of, failing and trying to do better the next time. And hopefully your winners make some real good multiples and make up for it. But
yeah. Well, and it's what makes you better at picking the right winners for the next time. So very good. So lately there has been a lot of talk here in Phoenix about, startups needing to move to Silicon Valley to launch or grow. Why do you see Arizona as a good place for entrepreneurs?
I think I'm biased a little bit because I grew up here, but Phoenix has grown tremendously, and it's a great place to live. It's very easy to recruit people here, which is critical when you're trying to grow a company. I think Phoenix has a really good infrastructure.
As long as you don't have them come interview in the summer, right?
Do not bring anyone here in July or August. That's a deal killer. But the infrastructure is good here, and unlike 15 years ago, before really the advent of the internet, where you can just share so much information all the time and access information, I think Silicon Valley had an advantage because there's so much there. But you can start a great company anywhere, and costs less. You don't have to raise as much money here as you have to there. And there have been excellent companies that have been started and have done well in Arizona and will continue to do well. I wish we had more capital here, because if we had more capital, it would certainly drive more business. It would keep more entrepreneurs here. They wouldn't feel like they needed to go to Silicon Valley. But I was in a conversation just before we came in here. The first venture groups in Silicon Valley raised funds of $3 million and $5 million and $8 million. Those were the first funds of Sequoia and Kleiner Perkins and some of those groups. And so you really do have to build the ecosystem in an area.
Hopefully we're on that cusp. So, you personally, where do you see I ten years?
Well, I'm hoping that I can keep doing what I'm doing. I feel fortunate to be doing this, and it's a lot of fun. And whether it's with a fund or my own money, there's nothing funner than working with entrepreneurs. Just the passion, the motivation, the desire. There's nothing better than seeing the next great opportunities and companies that can change the world or parts of the world. It's a tremendous amount of fun.
Anything else you would like to share with people?
I'm trying to think. I think, as I was saying before, more for the entrepreneur. Just be persistent. You have to have a good plan. Be willing to listen. Be willing to listen. There's so many great people out there who are willing to give advice. There's so much great information on the internet. There's probably never been an easier time to start a company, especially software or technology. There's so much available open source software out there to build companies on. And you can collaborate. You don't even have to be in the same location. You can be in different places around the country and around the world. And I just think it's probably the best time in the history of the world to start a company. And so I hope people will continue to do that.
That's good. That's good encouragement. Good to hear from someone like in your spot. So very good. Well, Thank you. We have 2 more things before you get down off of this stage. We do a little thing where we play 21 questions. So I'm going to give you some choices, and then after that we're going to take some Q&A time. So here we go. This is where people really get to know who Brian is. You ready for this?
I don't know.
All right. So first one, tacos or pizza?
Tacos.
From Arizona. Okay. I'll give you that. Android or iPhone?
iPhone.
All right. Paris or Hawaii? Mornings or nights?
Used to be nights. It's definitely mornings now.
Favorite business book?
Probably Good to Great by Jim Collins. That was a good one.
Favorite holiday?
Christmas.
Favorite hobby?
Probably reading history books, American history.
Wow, didn't see that one coming. Very good.
I don't know if that's good or bad.
No, it's just interesting. Favorite guilty pleasure?
Probably ice cream. My wife's still working on that one. That I probably won't give that one up.
Favorite sport to watch?
College football. Another week.
Favorite sport to play?
Is hiking a sport?
You can go with it.
My joints are. How about wakeboarding?
All right. Very good. Favorite food?
Probably French.
What in French?
French food. Not
Yeah,
French fries.
No. But I mean, immediately snails come to mind, and there's got to be a lot more than that.
Not escargot. I just love the cheese and the butter. And
okay. Oh, yeah.
All the good stuff.
Okay.
Not
I'll give you that. Good.
Not the carrots.
Favorite beverage?
I'm not really a drinker, so this is a boring one. So it probably just fruit beverage. Water.
Water.
Being from Arizona, I drink a lot of water.
I'm with you. I get it. Favorite movie or TV show?
That's a good. I loved was the Band of Brothers when they did the Band of Brothers about D-Day and all that. I guess that goes with the American history.
Yeah. Very good. Name a musician that you love.
I just went to the Paul McCartney concert. That was pretty great. So.
Classic. Anything you collect? Busts of old presidents?
Yeah. Stock options.
Stock options.
Worthless stock certificates from old companies. How about American history books?
Okay.
Yeah, I still like buying the book.
Yeah. Weirdest thing you have ever eaten?
Buffalo tongue. Pickled pig feet. Probably a tie.
Yeah. What is the best compliment someone can give you?
Probably just thank me for if I helped them. Someone says thank you. That for me, I don't know. That's for me is a good compliment.
2 causes you are passionate about?
One I find, and it probably goes hand in hand with history. I find genealogy really fascinating, kind of about roots and figuring out where you came from and finding that. And I think that's real interesting. And I think the other one, I'm probably swimming up current a little bit. Maybe it's showing my age, but role models for youth. I'm heavily involved with some youth groups, and it just seems like the role models, at least the ones that are in the public eye. Yeah, it's just whether it's sports or government or Hollywood, it's too much on the people who are having problems and kind of crashing in life and things like that. At least when I grew up, there's these astronauts and there are these role models that really made you want to achieve and do something. And I'm not sure if our kids are getting that. I think they're just seeing fame and fortune and people becoming famous for really not the right reasons.
One thing on your bucket list?
African safari.
Coming full circle here, aren't we?
Not wrestling them now. Done with that.
If you could have one wish granted, what would it be?
Well, I have 4 kids, so, you spend a lot of time hoping that your kids have a great life and a great future. So that's probably the wish.
Finally, what is your favorite number? I mean, you're a numbers guy. Gotta have one.
About 11/21/92. I bet no one can figure it. That's my anniversary. So.
Oh, okay. Very good, very good.
My wife snuck in the back. I figured I better throw that one out.
Thanks for sharing. All right. Well, very good. We really appreciate you taking the time to do this. And we are going to open it up to people for a few minutes. Do we have a mic out there? Can we get a mic? Perfect. Would you mind? Thank you. All right. So if you have a question, feel free to get it ready for us. Cameron, my husband, will bring the mic around to you. And go ahead and state your name and then your question, and we'll go from there. I guess you got to raise your hand and all that stuff too, but we'll get there. We're still getting the mic. I have no idea.
Okay, all right. I didn't either.
There's no clocks in here.
Okay. My name's John Dahl. What kind of multiple are you typically looking for from entry to exit?
What we do, and this is one of the things that's different about venture, I think, than angel investing. If I was investing my own money on the side, I'd probably invest it a little different than what we do at venture. Is because a third of our companies probably are not going to be successful, even though we'll look at 600 business plans a year and we're going to pick 3 to 4 companies. Because of that, when we do have winners, they need to be pretty big winners. So we will initially target opportunities where we think over about 5 to 6 years, we have a shot at getting 10 times our money. And so and that's one of the reasons why I think if you are going to raise venture capital, the right time or the right circumstances to raise venture capital is if you have a really big market and you're going to go after it very aggressively, because that's the type of multiple we need to get for our winners to be able to provide a really good return and compensate for the companies that either go out of business or struggle and where maybe we get our money back or 2 times our money. But that's really what it takes for us to get the type of IRR in return. And I think that's pretty consistent for venture groups. I think you'd hear that a lot.
Colby Gergen, what are some steps that the Phoenix metro area can take right now to increase the amount of venture capital and other funding sources for startups in this area?
Well, we're, and I like to look at it as a kind of a food chain. Maybe it's my econ mind. We have to go raise money. And so we need good capital sources to raise money from. Phoenix has always been a bit of a real estate town. And I remember when I was first here and trying to raise money, people would say, well, I can make 20% doing real estate all day long. Why do I want to take a risk with these companies where I can lose everything? Because I will never lose anything in real estate. Well, we learned a hard lesson, right?
Right.
About that. You can lose money in real estate in Phoenix. You can lose a lot of money. And I think it was a little bit of a wake-up call that any investment you can lose money on. And since that time, I think there's been more interest from local high net worth individuals about putting money into venture capital and other alternative assets. So I think that would help. Most states, you have state pension funds and big companies that will invest in venture capital. Arizona does not. And so it's harder to raise money here to be a venture capitalist. If you're in Utah or Colorado or Texas or California, there's a tremendous amount of money that goes into venture funds, and then the venture funds give it to the entrepreneurs, right? It's part of that whole food chain. We don't have that. We don't have that in Arizona. And so that's been a little bit frustrating. I hope that'll change. I think it does need to change if we're ever going to get the capital we need to be able to provide the money for the entrepreneurs.
Hi. This is related. Could you talk a little bit more about the process, the technical side of this? So, for example, in the areas when you mentioned 7 million, you were out there raising 70 million. Excuse me, 70 million. First of all, how does that number come about? How do you get to choose how much that is? And secondly, related to that process, when people talk about, I guess the term is what, active funds, or I'd just like to know a little bit more about the logistics of that process.
So usually what you'll do is you'll try to get an idea of how much money you think you can wisely invest over a period of time, and then try to raise that amount of money. If you raise a small fund and you put a little bit of money into companies, sometimes it's not enough money to really help the company get too far down the road. And then if you don't have a lot of extra money to put in subsequent equity rounds, they can get squashed by the next round. And so when you do raise venture capital, you want to make sure that they're giving you $2 million, that they have dry powder for another $2 million down the road, which really helps protect the company. So we always want to make sure that we have an adequate amount of capital. And for most of these regional funds, 50 to about 100 million is kind of the right size, because we want to invest in anywhere from 12 to 15 companies. Most of the companies we're putting money in, we'll be doing about 3 to 6 million in the other venture group that comes in. We do like having good syndicate partners. They'll do about the same amount. So we back into that number a little bit. We didn't, in all candor, we didn't target 70 and hit 70 on the dot. We targeted 100, came a little short, and we're happy that we ended up with 70. And I think of the 5 funds that I've been involved with and helped raise, we've never come in right, kind of right on mark. But there are times where you turn away money because too much money, you just can't deploy it wisely. And you want to make sure that you're deploying it wisely for your investors and also for the entrepreneurs.
Hi, my name is Stacy, and I have 2 quick questions. One is my technical team and I have worked together for 20 years. We worked and developed very large projects in DC, starting with $9 million going up to an $87 million project. So we have patents in that. Recently, we've entered the video on demand world, and we're building an app in this. And we have done a lot of what you're suggesting in terms of mentorship and partnership and so forth. My question to you is this, 2-part question. One is, do we need to tie a patent to the company to make it stronger for a venture capitalist? And 2, we are sort of in this fine line of being advised that we might probably need a little bit less capital than you normally invest. And 2, we need a fast exit strategy is what we're being told by industry insiders, that there is a market here. Is it worth submitting a business plan to your company, or if it doesn't meet that 3 to 7 million, don't even bother us?
Well, we'll for us, we can put in as low as $1 million to start, and up to about 3. Usually, when we do a round, it's 3 to about 7 million. We'll have another investor. We like having other investors in with us because they have their own networks and they bring advice to the entrepreneur. We want to get as many good people around the table as possible to help the company grow. So I wouldn't get too hung up on, can this group be too small or too big? If it's a great opportunity, they'll find a way, right, to make it work. On the patent question, every technology is a bit different. If you have a technology that you could create a really great barrier to entry for other people coming into, I would definitely patent the technology. We're seeing in software, we're probably seeing fewer patents now because there's so much open source software, and it's a little bit more of a race to grab the market, and there's multiple different types of software that you can use off the shelf to really build your product. But if you have more of something that's less software related and is more either hardware related or I would definitely go down the patent route, especially if it truly does give you a barrier to entry for someone else coming in.
My name is Daniel, and I got a question about the seeding, the time frame from seeding to revenue. What is that typically for the companies that you've invested in?
Say the end of that again. So from seed to revenue?
Yeah, seed to revenue, and like, what is your patience for getting there?
Time frame. Most groups who are putting in seed capital, I would say within the first year, they would like to see the product works well, and you have a handful of customers who are using it, and they're getting really good feedback. It's probably less about pure revenue than it is about, is it meeting a huge need out there? Products are usually, a lot of products are nice to have. It can be really cool and everything, but the customer, they're a little bit indifferent. Yeah, it'd be nice to have it. But if you can create a product that's a really need to have type product, those are the products that get the investors excited. And even if you just have 2 or 3 or 4 customers, those customers are really excited, and you're providing a great return on investment, ROI, for them. That will help you raise that first round of capital after the seed round. That's really the key.
And then do you have more patience for revenue to profitability?
Yes.
What does that look like?
Well, and it's profitability sometimes can be a little bit more open to discussion, right? If the market's big and the product is taking off, you don't want to cool that down just to get to profitability. You want to grab as much market share as possible. So then the question is, how much money are you going to burn? How much do you need to get to a certain amount of market share or customer? And that's all going to determine how much money you spend and when you wait to get to profitability. Once a company gets going, the ongoing discussion is, all right, how much sales and marketing are we going to put to work here? How much money do we have to really spend? And that is something that is always, it's an ongoing discussion internally. It just always is.
Hey, Brian. My name is Jason Gladstone, and first of all, go Hoosiers.
Yeah.
So just a quick question. You mentioned the tech bubble a couple of times, talking about your experiences, and recently you mentioned kind of the housing bubble. So for the last 4 years, we've been seeing kind of a big uptick in stock market housing prices. Things are coming up on the rise. How far do you think, and just, I know it's an opinion, but how long is that going to last, do you think? Are we headed for another bubble? I mean, what's your opinion on that?
Yeah, I don't know. You're making me put my econ desktop, my econ brain here, and you just always worry anytime interest rates are so low and there's a lot of easy money out there. Although there hasn't been as much borrowing as I think the Fed thought there was going to be. So maybe, and real estate hasn't bubbled. We haven't really seen the tech markets bubble, although the last year valuations have increased quite a bit. And there's a little bit of a worry that we may be getting a mini tech bubble, nothing like we saw before. The stock market, I think people are putting money in stocks because not sure where else to put it. And so we chances are there's a bubble there. We, just like an entrepreneur hates bubbles bursting, we hate bubbles bursting because at any given time we'll have 1 or 2 companies who are at that point where they're trying to get sold. And when a bubble bursts, you delay that 2 or 3 years, right? You have to make sure the company has enough money to be able to make it through that downturn. So I hope we're not heading to bubbles, but you never know.
My name is Evo, and Boomer Sooner, so because college football season is coming up. We work with a lot of late-stage startups and trying to teach them how to become real businesses. And earlier you mentioned something about the level of communication that venture funds and, for that matter, angels and anybody else is going to want to get out of a company. But a lot of entrepreneurs and startups struggle with crossing the line between not enough communication, and in which case their money knows nothing at all, and then over, just sending them the newsletter that goes out every day, which is probably too much. Can you talk a little bit about the level of communication you guys are looking for?
Yeah, great question. The first thing that I talk with an entrepreneur about is I want bad news first. I want bad news immediate, right? And that's a hard thing early on for an entrepreneur, and it really does take a great relationship, because an entrepreneur is in sales mode, and they have to be in sales mode, right? They got to believe in it, they got to be passionate, they have to make it work, and they don't want to hear bad news, right? They don't want to deal kind of with the ugly facts that sometimes are getting in the way, and I think it's one of the reasons why, at least I'm so adamant when I work with entrepreneurs about getting bad news. With good news, we can pat you on the back and say, that's great, keep up the good work, but we can't add any value. Bad news is we have to get through that to be able to get the company to the next level. And with a startups are, it's like raising a teenager. I have 3 teenagers. You know that the car is going to get banged up, right? It's just going to happen because things are moving too fast. You're going to take a wrong turn. There's going to be a problem. And I just think having the communication and developing the relationship with the entrepreneur, no one ever wants to give bad news, but is at least comfortable of saying, hey, this happened, we need to deal with it. Those are the entrepreneurs I just love to work with. And you gain a tremendous amount of confidence knowing that they're on top of things and they're not afraid to deal with the problems, and they're going to bring them up. So bad news on the communication side is key. We want monthly financial statements. We usually have certain metrics in a company that we want them to track, and we'll follow those. And usually those metrics are things that are, if they will focus on them, they're designed to get them the best outcome down the road and create the most value. That's the main thing. And more than anything else, we're a sounding board. We've been through, between my partners and I, 75 companies, and so it's pretty rare when we're surprised with some problem. Now that I'm on my 3rd teenager, I kind of know what some of these themes and it's pretty similar to that, I guess.
Hi, my name is Todd Rethmeyer. My question's, I guess, about the exit strategy for your investments. Do you have a preference between selling the company outright and taking it public?
In the 90s, we loved the public markets, and then they went away. They're starting to come back, and I wish that they would fix some of the Sarbanes-Oxley and some of those problems so we could have more public companies. We need more public companies. We're a bit indifferent in some ways. If you can get a great strategic partner, in some ways we would prefer the sell, because once it goes public, your scrutiny and hitting numbers every quarter is so high, and if they miss a quarter, the stock flattens out, then it's harder for everybody to get out. And so I think the preference for us is a really good strategic buyer to come in.
And I guess then to follow up, if you could get from a strategic buyer, you could get 10 times your investment back, how much would you need to get back to go through the process of going public and then dealing with Sarbanes-Oxley and all of that? How much of a premium do you need?
I would say you're probably a 50% premium on going public versus what a corporate would buy you for. Yeah, probably 50% higher in the value, because you're taking a ton of risk once you go public. The quarterly scrutiny is really brutal, and it's usually at a point where the company's still maybe almost a 20-year-old or a 21-year-old, right? There's still going to be a lot of challenges down the road.
Any other questions?
Last one. Thank you.
Hi, my name is Steve Walker. A couple questions for you. One is, how do you typically find your investment opportunities? Do they come knocking on your door, or do you have your own crystal ball?
Yeah, it's kind of all the above. We love the repeat entrepreneurs. Those are the people who we have a high degree of confidence in working with. A lot of times we'll be investors in a company and we'll have someone who maybe they were the VP of sales or marketing and now they've started something and taken one or two of the developers with them. We get a lot from, the good law firms like the two you have here. They bring us quite a bit of business. Other venture groups, we'll hear about opportunities there. We know the angels real well, so we get calls from angels, some of our investors. It's kind of all the above. And then in a market like Arizona that's small where there aren't a lot of other venture capitalists, we're kind of friends of a friend, right? We get a lot of that. And what I would encourage is if you do want to approach an investment group, find someone who knows someone there. It's a lot easier to come in, kind of a friend of a friend. You'll get a much kind of more detailed look, harder look than you will if it's just sight unseen. And we do get tons of business plans that just come in unsolicited. We don't spend as much time with those just because the volume is so heavy.
One more question I have for you. So are the funds typically attached to milestones? So when you fund $5 million, is it conditional upon milestones, or is it just a check written? And
it's more milestone driven. You want to have an idea of, okay, this money is going to get us to this point in about 18 months. And if you're targeting 18 months and you're out at 12 months, that's a problem, right? If you're at 18 months and you have more money, that's usually a good thing. You want the money to be managed as well as it can. But it's usually milestone driven. It's not hard and fast that, okay, if you don't hit the milestone, we're not putting any more money in. But you want to, when you put in the money, you want to make sure that you're increasing the value of the company so that when you raise the next round, you're raising it at a higher round, preferably. If you're raising a lower round, then everyone's going to get crammed down, including the entrepreneur, and nobody wants that scenario.
Okay, and then how often do you extend beyond your original commitment? Just out of curiosity, like as a percentage of your deals, how often do you have to dig deeper into the checkbook?
So almost every investment we will make at least one other investment into it, if not a third investment. It's rare that we write a check one time and they don't need any more money. That's pretty rare. Because usually we're still real early in the company. Maybe they have $1 million or $2 million or maybe up to $3 or $4 million in revenue. But for them to really hit break even, they'll probably need to be at 10 or 12 million, maybe even 15 million if they're trying to grow fast. So we always anticipate that we're going to write the next check. We'll keep dry powder available to be able to do that. We just want, and the entrepreneur wants, that to be the most optimal time possible, right? I mean, the higher price you get the next round, the more ownership the management team is going to keep. And the more successful they'll be down the road, which is really the game.
I just have one quick question. Cameron Kerner, this is a pretty lowbrow question, but I was just curious as to your impression of TV show Shark Tank.
I was waiting for that question. That's my wife's least favorite show. I told her, I kind of do that. And anyway, it's a lot of fun, right? And they kind of condense what we do in 2 months down to about 10 minutes. But I actually like it. And I think the questions they ask, for the most part, are good. Some of the posturing on the valuation, how we're going to do this, but some of that's a little hokey. But they do ask good questions, and I think for entrepreneurs to be able to watch that and understand the type of questions you're going to get, I actually think it's really good. And they, of course, they got to have fun with it. the show's going to go off the air, right? And, but anyway, it's a fun show, and I think entrepreneurs can learn a lot from it.
Very good. Well, thank you so much, Brian. We really appreciate you. Thank you very much.